Whether the President of the United States should or shouldn't put his name to this equity market rally or not, based on what do you think we are up here at Dow 22,000 there and thereabouts, the S&P 500 at a record high? When you look at what's come out of DC, we can say there's been no major policy initiative out of DC, but certainly the tone towards businesses, towards markets, towards the economy has changed, and it's been captured in many ways by the sentiment data over the last few months.
I think so. You put your finger right on it. The sentiment data, the momentum data, so the short-term numbers are really driving the market. And what we see coming out of Washington perhaps is better than getting a reform agenda, is getting nothing. There's these stalemates. There's gridlock in Washington. Markets tend to like that. The economy is doing okay. It's about 2%. We don't think there's going to be a recession. Earnings, for a number of reasons, in the first half of this year look pretty good. So a lot of those short-term numbers and momentum data can really burn through. But we think longer-term valuations are something that you really want to take into consideration.
Well, you put your finger on earnings. Yeah. Because that's not just sentiment. A number of companies have done really, really well now for a couple of earnings turns. The question is, what do you expect in the second half? What's driving earnings? What will drive them going forward?
Yeah, the first quarter was obviously extremely strong. Second quarter, less so. So we think that earnings are coming a little bit off the boil. In the U.S., some of the major reasons are, the base effects predominantly from energy and oil, not exclusively, but predominantly. Also, if you look at the global and international composition of earnings in the first and second quarter, that's something that's going to come off the boil as well. So you get an earnings environment going into the back half of this year that looks okay, probably mid-single digits, a bit higher for the back half. So again, fundamentals are good. Not to say that they're not, but are they good enough to support these valuations?
Well, that is exactly the question. But to come back and argue the other side of it a little bit, you still have very accommodative monetary policy. Even with the Fed moving, it's still very, very, by historical terms, very accommodative monetary policy. You've got a weakening dollar, which helps a lot of U.S. companies to make a lot of money overseas. You've got not stellar, but solid growth, consistent growth over time. All those might indicate to a company we're going in the right direction.
I think that's a reasonable expectation. So we don't have a bearish call. I don't think it's a recessionary call. We just think that this is a good opportunity for a U.S. investor who's probably gotten out of balance in their equity allocation. Over the last 5+ years, to take a rough number, of 50-50 U.S., non-U.S. has become distorted in favor of the U.S. So just trimming back to policy, and then you're looking at monetary policy in Europe, which is going essentially the other direction of the U.S. If you're looking in Japan as well. So where you marry valuations with fundamentals and monetary policy, again, just be incremental. You don't want to panic. You don't want to do anything extreme. Just marginally take advantage of these opportunities.